So in just the first 6 months of this year, a handful of tech giants borrowed, they borrowed more money than Moody's projected they would borrow in all of 2026 and 2027 combined.
Which is just a staggering amount of capital.
Right. It's huge. And the craziest part is that the company generating the highest profit margins off this whole, artificial intelligence infrastructure boom, it isn't designing microchips.
No.
They aren't assembling server racks, and they definitely aren't laying fiber optic cables. They are literally just grading the paperwork.
Yeah, it is the ultimate asymmetrical bet on the expansion of the global economy.
Exactly.
Because when you look at the sheer velocity of capital formation happening right now, just to support the physical layer of the internet, the bottleneck isn't just silicon anymore.
Wait, if it's not silicon, what is it?
The bottleneck is trust. Institutional capital simply cannot flow into a 350 megawatt hyperscale campus without a standardized, universally accepted metric of risk.
Oh, wow. Yeah, that makes a lot of sense. And that is exactly what we are dissecting today on this Talk Tickers Deep Dive.
Glad to be here.
Welcome, everyone. If you're new here, our mission is simple. We are translating all that dense Wall Street jargon into actionable insights for you, the retail investor.
Because you shouldn't need a finance PhD to understand what you're buying.
Exactly. And today we're focusing on Moody's Corporation, ticker symbol MCO, specifically their Q2 2026 earnings.
Right. And as always, we're going to hit the headline numbers first, then the story behind them, management's guidance, and finally, our bottom line verdict on the stock. All while, keeping it concise and respecting your time.
Okay, let's unpack this. Starting with the 30,000-foot view, the headline numbers here they were massive top and bottom line beats.
Yeah, they really were.
Enterprise revenue grew 15%, but adjusted operating income surged 25%.
It's just a huge gap, right?
It is. And that drove adjusted diluted EPS to $4.68, which is up a staggering 31%.
So the divergence between that top line and the bottom line, that is the most critical starting point for anyone looking at this stock.
Right, because 15% revenue growth is great, but 31% EPS growth means something else entirely is happening under the hood.
Exactly. In a mature financial services business, 15% top-line growth is a formidable achievement on its own. But that 31% EPS expansion, that forces you to recalibrate your entire valuation model.
Yeah, and that disparity is basically a masterclass in operating leverage.
It really is.
For those listening, the easiest way to think about operating leverage is it's like running a factory where the rent is already paid for the month.
Right, your fixed costs are covered.
Exactly. So every extra widget you sell after that rent is paid, the profit from that drops almost entirely to the bottom line.
And Moody's is the digital equivalent of that factory.
Right. They expanded their adjusted operating margin by 440 basis points to 55.3%.
Which is it's a massive expansion for a company of this size. They're absorbing all this massive transactional volume without a commensurate increase in overhead.
Right. They don't need to hire 5 times as many analysts just because the bond issuance has more zeros on it.
Exactly. And to see where this leverage is really coming from, we have to look at the segment breakdown. You have 2 main divisions, right?
MIS and MA.
Right. So first you have Moody's Investor Service, or MIS. This is the legacy credit rating engine.
The classic Moody's we all know.
Right. Transaction revenue there skyrocketed 34% this quarter. And that was driven by the fact that rated debt exceeded $2 trillion for the second consecutive quarter.
$2 trillion. That's just, the scale of that is hard to even wrap your head around.
It is. And the margin on that MIS segment hit 68.3%, which is up 410 basis points.
So basically, for every dollar of transaction revenue coming in, nearly 70 cents drops straight to operating profit.
Exactly. It's incredibly lucrative. But then you have the other half of the business, which is Moody's Analytics, or MA.
Right, the software and data side.
Yeah. And their annual recurring revenue, their ARR, reached $4.7 billion this quarter.
Which is up nearly 9%, right?
Yes. And their margin expanded to 33.6%. So you have this high margin cyclical transaction business paired with a massive compounding recurring revenue floor.
Right. But numbers this big, they don't just happen in a vacuum. To understand if this is sustainable, we have to look at why everyone is suddenly borrowing so much money in the first place.
And this is where the physical reality of the AI boom comes into play.
Right. Here's where it gets really interesting. Because retail investors, they are obsessed with buying AI chip stocks right now.
Oh yeah, everyone wants the next NVIDIA or AMD.
Exactly.
Yeah.
But they are completely missing the infrastructure play.
Which is arguably the safer bet.
I think so. Because Get this, the hyperscalers, your Microsofts, your Amazons, Google, they have already exceeded Moody's entire 2026 forecast for debt issuance.
In just the first half of the year.
In just 6 months.
Yeah.
And hyperscaler CapEx is expected to approach $800 billion in 2026.
Which is just a mind-bending amount of money. And it's flowing directly into heavy industry, right? It's not just software anymore.
No, it's concrete and power grids.
Exactly. To put this in perspective, management highlighted the Beacon Point DC transaction on the call.
Oh, yeah, the Hut 8 deal.
Right. This was a $4 billion financing package for a single 350 megawatt hyperscale campus being developed by Hut 8.
$4 billion for one single facility.
Yes. And you can't just get $4 billion from institutional investors without someone underwriting the risk on a facility that massive.
But let me push back on this for a second. Are we just slapping the letters AI on everything?
It's a fair question.
Like, is Moody's over-reliant on this AI hype train? Because we saw this in the early 2000s with the telecom bust. What happens if this train derails?
So what's fascinating here is that the data they provided paints a totally different picture. It's not just an AI story.
Okay, how so?
Even if you completely exclude all the AI and hyperscaler activity, global debt issuance still grew at a double-digit rate.
Oh, wow. Wait, really?
Yeah. In fact, 80% of Q2 issuance was highly diversified and completely divorced from the AI narrative.
Okay, so where is all that other money flowing if not into data centers?
A huge chunk of it is going into private credit. We saw private credit transactions grow over 40% year over year.
That's a massive shift away from traditional bank lending.
Exactly. And as private credit moves from institutional money to high net worth retail investors, they need independent risk assessment. They need mark-to-market valuations.
And Moody's is stepping in to be that default language for the market.
Right. And then you have their push into digital finance, which is totally wild. They actually rated BlackRock's $2.6 billion tokenized money market fund.
The BUIDL fund.
Yes. And they even integrated their proprietary token engine directly with Solana.
Wait, they're putting credit ratings on chain, on Solana.
Yep. They are aggressively positioning themselves at the intersection of traditional finance and blockchain, ensuring their analytical frameworks are the foundational layer, regardless of the technology.
That's incredibly forward-thinking for a legacy financial institution. But let's shift gears and talk about the analytics engine, the MA segment.
Right, the software side.
Because 99% of Moody's analytics revenue is now recurring. That is a dream metric for any software company.
It really is. And they just brought in a new CEO for MA, Christina Kosmowski, who comes from a deep Silicon Valley background.
Right. She's a lot of experience scaling enterprise tech.
Yeah, and she's immediately pushing them toward what she calls agentic AI.
Okay, translate that for us. What is agentic AI versus just regular generative AI like ChatGPT?
So regular generative AI requires a human to prompt it constantly. You ask a question, it answers. Agentic AI acts as an autonomous agent.
Okay, so it does the work for you.
Exactly. It can chain tasks together, retrieve data, and execute models without you holding its hand. They actually just launched their first AI skill directly into Microsoft 365 Copilot.
So an analyst doesn't even have to leave Microsoft Word to pull a Moody's credit model.
Precisely. They just type a command, and the AI queries Moody's database, runs the frameworks, and drafts the technical assessment right there in the document.
That makes the software so sticky. It's not just a tool anymore, it's literally part of their workflow.
Right. And they're doing the same thing with cloud migrations for their insurance clients. They're moving them to the Intelligent Risk Platform, or IRP.
Which ties directly into their AWS partnership, right? This part was fascinating.
It is brilliant sales engineering. Basically, if an insurance company buys Moody software on AWS, it counts toward the massive cloud spending commitments they already owe Amazon.
So buying Moody software actually helps the client satisfy a debt they already have with AWS? That removes so much friction from the sales cycle.
Exactly. It's a huge competitive advantage.
Okay, so the current story is clearly firing on all cylinders. But does management think this party continues into the fall?
Well, their guidance was actually pretty nuanced, and it caused some confusion on the call.
Yeah, let's talk about the volume versus yield disconnect, because this was a confusing point from the transcript that we definitely need to translate.
But it's crucial for understanding the back half of the year.
Management raised their global debt issuance outlook to mid-single-digit growth, so they expect more volume.
Right, more total debt being issued.
But they kept their MIS revenue guidance totally flat at high single-digit growth. So why does more volume not equal more revenue?
It comes down to who is issuing that debt. The extra volume is coming from what they call frequent issuers.
like the megabanks and the hyperscalers.
Exactly. Because Microsoft or JP Morgan is accessing the capital markets constantly, they don't pay retail rates for a rating. They get volume discounts.
Ah, okay. It's like going to Costco.
Exactly like Costco.
When you buy in massive bulk, you get a volume discount. So Moody's is grading a ton of bulk debt for these massive data centers. So the fee per dollar, the yield is actually lower than if they were rating a highly complex boutique insurance deal.
Right. The raw volume is massive, but the yield per dollar is structurally lower because of those pre-negotiated contracts.
That makes perfect sense. But then there was also the Q3 warning. Management expects Q3 revenue growth for MIS to be low single digits.
Which sounds bad, right?
It sounds like a severe deceleration, but it's actually just an illusion created by timing. It's what they call the pull forward effect. Okay, break that down for us. Why did it get pulled forward?
Well, think about the macro psychology earlier this year. In April, the market hit an air pocket. Inflation data got weird, geopolitical tensions spiked, and the Fed was being super vague about interest rates.
Right, nobody wanted to make a move. The liquidity basically froze.
Exactly. Corporate treasurers paused all their debt plans. But then in June, things stabilized slightly. And those treasurers looked at the upcoming U.S. election in November. They looked at potential fall volatility, and they panicked.
They just rushed the gates.
Yes. They unleashed a synchronized rush for capital. June saw record-breaking issuance levels, so a massive amount of debt that was modeled for August or September.
That just got issued in June instead.
Exactly. The total volume for the year hasn't changed. The revenue just shifted from Q3 to Q2.
Okay, that is super important context. So looking at the updated financial targets for the listener's spreadsheets, despite that Q3 shift, the year looks phenomenal.
Very strong, yes.
They raised their EPS guidance midpoint to $16.75.
Right.
They increased their share repurchases to a massive $3 billion for 2026.
Which is incredibly aggressive capital allocation.
And they adjusted their free cash flow slightly to $2.7 billion, which I think they said was due to some restructuring and working capital timing.
Yeah, that's just near-term noise. The vital metric there is that they're returning over 130% of their free cash flow to shareholders.
Wait, 130%? How do you return more cash than you generate?
By liquidating excess cash held on the balance sheet from previous non-core divestitures, they are refusing to hoard cash, which is extremely shareholder-friendly.
So we've crunched the data, we've translated the guidance, and we've analyzed all the drivers. Now let's give the listener the ultimate verdict.
Let's do it.
So what does this all mean? Are we bullish or bearish on MCO right now?
If we connect this to the bigger picture, I am taking a very strong bullish stance.
Okay, tell me why.
Because Moody's is proving to be the ultimate toll bridge for global capital.
I love that analogy.
It's true, though. Whether the world is funding AI data centers or green energy transitions or shifting to private credit, the capital must cross Moody's bridge.
Right.
And they take a highly lucrative fee without taking on any of the construction risk.
They just grade the paper. And the actionable insight here for anyone holding the stock is that the margin expansion is the key takeaway.
Absolutely.
Because they actually expanded their restructuring program out to 2027, targeting up to $350 million in savings.
Which is wild when you think about it.
Right. They are getting leaner exactly as revenue is surging. Usually when a company sees a 34% spike in a core business, they get sloppy and cost structures bloat.
Yeah, they overhire, they expand offices.
But Moody's is doing the opposite, which is a recipe for massive free cash flow generation.
And that cash flow is what funds the $3 billion in buybacks.
Okay, before we wrap up, I want to leave the listener with a final provocative thought from the Q&A session.
Oh, the AI token cost collapse. This is the best part of the call.
Yes. Analysts asked management what happens if AI computing costs just absolutely plummet.
Right. As chips get faster and more efficient, the cost to execute an AI query, the cost per token, is dropping to near zero.
So if cheaper AI destroys companies that are just AI wrappers, companies just reselling a ChatGPT interface, how does that impact Moody's software pricing?
Well, management explained that it's actually a massive tailwind for Moody's.
Why? Wouldn't cheaper AI mean cheaper software?
Not if you own the data. Moody's owns proprietary, meticulously structured data on 630 million entities. That database was built over decades.
You literally can't replicate that, even with infinite cheap computing power.
Exactly. So if the cost of the AI engine drops, Moody's profit margins on their software only go up because their true moat is that underlying irreplicable data and the institutional trust they've built.
So the foundational AI models are basically becoming a commoditized utility, like electricity.
Right, and the proprietary data is the scarce resource.
This raises an important question for you, the retail investor, as you look at your own portfolio. Are you investing in the AI engine, or are you investing in the proprietary fuel that powers it?
It's a critical distinction for the next decade of investing.
It really is. Well, thank you for joining us on this Talk Tickers deep dive into Moody's Q2 2026 earnings. Keep looking past the jargon and straight at the numbers, and we'll catch you on the next one.